Hey, this is Darren from Property Prosperity. I was watching the TV tonight and I was watching the government quiz the big banks and just basically try and make them feel bad for their dodgy practices. And to me, I suppose it seemed a little bit like, you know, calling up a lion and sort of making him feel bad for eating a gazelle. At the end of the day, a lion may say, "Oh, I'm really sorry, I shouldn't have done it," but he's going to go back and kill another gazelle the next day. Similarly to the banks, the thing to understand about banks, their whole job is to make money for shareholders, and they'll do whatever they have to do to be able to make money for shareholders. And so they may feel bad that a few people have had their toes stepped on along the way, and they may look back and regret it. But likewise, at the end of the day, they're going to keep going out there working out whatever way they possibly can to try and make as much money as possible. And the thing to understand, the system's never going to change because it's a big business and their job is to make lots of money and at whatever cost there happens to be. So, and they have this, the banks are such a big company, and there's essentially four major banks in Australia, and they've got so much power and so much dominance over the market, they can essentially do whatever they want. They can all essentially work within themselves and do exactly what each other does, and then there's nothing anyone can do to stop them. And we sort of experienced that a little bit through the GFC. We realised that everyone was a bit worried about what was going to happen during the global financial crisis, and so the banks then shouted out, say, "Hey, what happens if we go broke? We can't go broke because we're a massive big company and it's going to affect the whole economy." So what happened is the government came in and they guaranteed their securities, essentially saying that, "Hey, if anything goes wrong, we're going to cover you, Mr. Banks." The thing about it is they only covered the big four banks, and so the big four banks were covered. Then regardless of what happened, they knew the government was going to back them up. And what that meant for the banks borrow their money from someone else so they can lend it to you. So what that meant is because they were looked at as less risky than some other banks, so they got their interest, they could borrow money at a lot lower interest rate than some of their competitors. And so there is other competitors besides the big four banks. There's what's sort of like non-banks or smaller banks that they're competing against. During the GFC, because the big four banks were backed by the government and the non-banks were, or the small banks were left to, deal with it themselves, then they all really struggled. And because they were borrowing a lot higher interest rates from other lenders, and so that meant that they were borrowing it higher, trying to compete against the big four, which meant most of them during the GFC really struggled. And if they didn't go broke, they went very close to going broke. And what that meant was every year the big four banks were making record profits. And because each year they keep crying out, "Oh, but we're going to go broke," so the government would continue to cover their, guarantee their security. And so essentially each year they made more and more money and record profits. And so what they did was they started buying out all the competitors. So essentially it got to the point now, even if you choose not to go with the big four banks because you might get annoyed with the fact that they've sort of got a big corner of the market, if you go anywhere else, they're probably owned by the big four banks anyway, or the big four banks probably lend money to those other lenders that you're going to go to anyway. So regardless of who you go through, whether you go through the big four banks or whether you go through majority of the other lenders, the money's going to go back to the big four banks anyway. So that's the first thing to understand, is the banks are out there to make money and they'll do whatever they have to do to make money. And so the reason why that's an important thing for you to understand, at the end of the day, banks don't care about you and they don't care about what your situation's at. They're looking for whatever's the least risky strategy for them and what's going to make them the most amount of profits. So why does that matter when we're borrowing money, and why should we think about it? The thing to understand, banks want to lend you money when you don't need money. So when you've got a lot of money in the bank and you own all these assets and you've got a really good job where you're earning heaps of money, that's when the banks want to lend you money because you're considered a less risky investment or less risky person to lend money to. So they're almost willing to lend you whatever you want. And so whereas if something happened to you, if you suddenly lost your job or suddenly something happened where you had to sell your property and didn't have as much money as you otherwise would have, the banks aren't going to want to lend you money. So they're going to look at you as a risky person to lend money to, and they're unlikely to lend you money. So basically, and then that makes sense. You'd understand why a bank wouldn't want to lend you money if you don't have any money, and likewise why they'd want to lend you lots of money when you've got lots of money. The reason why that matters to you is generally, you can almost look at it as a bit like an insurance policy. At the end of the day, you really want to have some money there for a rainy day if you need to borrow it. And so what you can actually do, you can actually go to the bank when you've let's say you've got lots of assets, or let's just say you've got a good job. Basically, two things banks care about is they care about how much cash you've got, and when you're borrowing money, that's called your contribution or loan to valuation ratio. So how much your property is worth relative to how much you want to borrow. And so banks will lend you up to say 80% of the value of your property. And so they'll actually, even if you don't actually need the money for anything, they'll actually refinance up the value of your property, and that might be as a line of credit, or you can set up an offset account or something like that. So they'll lend you money up to the 80% of the value of the property, and then you don't actually have to use that money. So you can use it. You can go on holidays, or you can buy a car, or you buy an investment property, do whatever you want. But you can actually refinance up your house, borrow that money, which will go into your bank account, and then pay back down that loan. But the actual approval for that loan will still be in place. So let's say you borrow up to 80% of the value of your property, but you don't need all that money. And so what you can actually do is put that money back on your loan, reduce your loan balance back down to zero again, so 0%, but they've already approved your loan for the 80% of the value. So the cool thing about that is just gives you some money for a rainy day. Because the cool thing is, if your situation changes, suddenly you don't not earning the income you're hoping for, or suddenly the market changes or something happens, the banks, because they've already pre-approved you, essentially they've already approved that loan for you, and the money's just sitting there waiting for you to draw upon it. You don't have to go to the bank and ask for that money again. You won't have to supply bank slips or pay slips, or all your council rates, or all the other sort of stuff you normally have to supply when you get a loan. So the money's just sitting there if you ever need it. So like I said, it's a bit of an insurance policy, and so if anything ever does happen, you lose your job or you're out of work for a period of time, then you can draw down on the equity from your property and then live off that for a period of time until you get yourself back on your feet again. So you can sort of see why it's important to borrow money when you don't really need it. I'm not saying you necessarily borrow the money and go out and spend it. I'm saying you borrow the money and then pay down the debt again, but just leave it sitting there as available funds that you can use whenever you need it. So saying this, it does take a bit of willpower in the fact that you know that you've got 100 grand sitting there or 200 grand sitting there that you can draw upon. You can basically, just like a credit card, and just go out and pull the money out whenever you feel like it. The danger is you might suddenly, your cat gets sick, or you feel like you need to go on holiday because you've been working really hard, or your missus needs some new diamond earrings or whatever. It's really easy to spend that money. So the key is to try to look at it as not as money there for a rainy day, that money you can't spend. So the problem is, it always feels like every day is a rainy day, so you always feel like you should be spending that money. But so that's going to be the really hard thing for you. But if you do have the willpower and the ability to leave that money there, then you're not being charged interest on it, because you've put it back against the loan, so the loan's back down to zero anyway, and you've got it sitting there available for when you need it. Because, like I said, if you ever need the money and you want to go to the bank and borrow some money in an emergency, generally that's the time they're not going to lend you the money. So better to borrow the money now when you don't need it, and then you've got it sitting there for a rainy day as a bit of an insurance policy, just in case you really need to, get yourself by a difficult period in your life. Likewise, particularly this is really important if you're a small business owner, or any business owner essentially. You never know what's going to happen as a business owner. You never know when you're going to need some money. You never know when you lose that big contract with that big customer, or who knows, could anything happen. Basically, someone come and steal a whole pile of stuff here for you. You could have a natural event, could wipe out half your stock, and you actually need to rebuild again. At that point in time is the worst time to be going to the bank saying, hey, I need some borrowed money because I had this issue happen in my life. Basically, what you want to do is borrow the money when you don't need it, so that if an emergency happens with your own business, it's so likely that you're going to have an unforeseen event, and obviously as a business owner, those events can be, $20, $40, $50, $100,000, $200,000 even. So they're seriously big money. So it's not something you can cover with, just getting a personal loan or using your credit card or something like that. So it is important that you've got that bit of a safety net there to back you up. So definitely for a small business owner or a medium-sized business owner, but even for anybody, I'd really suggest, if you're in a situation where you can borrow some more money and you can just pay down the debt and leave it sitting there for a rainy day, then definitely now's the time to do it. So hopefully it's made sense. Hopefully you understand now why it would make sense to borrow money even if you don't need it. And if you like what I had to say, then click on the like button. If you've had an experience where you've borrowed some money and just paid down the debt but just leave it sitting there just in case you needed it, and then you've found an experience where it's actually worked out for you, something's happened, you've been able to draw upon that money and it's got you through difficult times, then I'd love to hear about it, love to know more about it. And so click on the like button or put a comment in the comment box, or if you know someone that they may be in the situation where you think maybe they're flying a little bit close to the sun, and maybe they should get a bit of an insurance policy. And maybe click on the share button. Hopefully they, take my advice and, give themselves a bit of protection for the future as well. So thanks, guys. I look forward to talking to you soon. And yeah, if you like it, click on the share button. If you, I'd really appreciate your likes as well. So have a good day. See you next time. Bye.